In 1990, if you had invested just $1,000 in the S&P 500, you would have over $23,000 today. $1,000. $23,000. Without doing a single thing. No second job, no side hustle, no luck. Just understanding one simple concept: the stock market. But here's what's crazy. Less than 20% of people under 35 own a single stock, while the top 1% owns over 50% of the entire stock market. And the difference between those two groups isn't intelligence, it's not luck, it's not connections. It's knowledge. The knowledge of how this system works. The knowledge that nobody taught you in school. The knowledge that, once you have it, changes everything about how you build wealth. Right now, there are millions of people out there working 40, 50, 60 hours a week, trading their time for money, while the market is working 24 hours a day, 365 days a year, for people who understand it. In the next 26 minutes, I'm going to walk you through exactly how the stock market works. From the very basics, all the way to how you can actually start participating in it today. No complicated jargon, no confusing charts, just clear, simple, powerful knowledge. By the end of this video, you will understand the stock market better than most adults who have been ignoring it their entire lives. Let's go! Welcome to Finance Advisor, the channel where we turn complex financial concepts into knowledge you can actually use. If this is your first time here, welcome to the family. Hit that subscribe button and turn on the notification bell so you never miss a video. And if you get value from what I'm about to share, drop a like. It helps this channel reach more people who need this information. Now, let's start from the very beginning. Let's start with the most basic question. What is the stock market? At its core, the stock market is a marketplace. Just like a farmer's market where people buy and sell vegetables, the stock market is where people buy and sell ownership in companies. That ownership is called a stock or a share. When a company issues stock, they're essentially saying, "We want to grow. We need money. In exchange, we'll give you a piece of our company. And when you buy that stock, you become a part owner of that company." Let me give you a real example. Imagine Apple is worth $3 trillion. They have 15 billion shares outstanding. Each share represents a tiny fraction of the company. When you buy one Apple share, you own a tiny, tiny piece of Apple. Their profits? Partly yours. Their growth? Yours too. Now, why would a company sell pieces of itself? Because growth requires capital. Let's say you have a bakery. Business is booming. You want to open 50 new locations, but you don't have the cash. You have two options. 1, borrow money from a bank and pay it back with interest. 2, sell shares of your bakery to the public. No repayment required. When a company sells its shares to the public for the first time, it's called an IPO, Initial Public Offering. This is literally the moment a private company becomes a public company. And once those shares are out there, they trade on what we call a stock exchange. In the United States, there are two main exchanges. The NYSE, New York Stock Exchange, founded in 792, the oldest and largest in the world. Companies like Coca-Cola, JP Morgan, and Walmart trade here. The NASDAQ, founded in 971, known for technology companies. Apple, Google, Amazon, Microsoft, all on NASDAQ. These exchanges are essentially the arena where buyers and sellers meet every single day to trade shares of companies, Monday through Friday, 9:30 a.m. to 4 p.m. Eastern Time. The market is open for business, and every second of every trading day, prices are moving, changing, responding. But why do prices move? That's what we're getting into next. This is the question everyone asks. Why does a stock go up? Why does it go down? And why does it sometimes move for no obvious reason? The answer comes down to one fundamental law of economics: supply and demand. When more people want to buy a stock than sell it, the price goes up. When more people want to sell a stock than buy it, the price goes down. But what drives people to buy or sell? 3 main forces. Force number 1, company performance. If Apple reports record profits, investors get excited. They want in. More buyers. Price goes up. If a company reports massive losses, investors panic. They want out. More sellers. Price goes down. This is why companies release earnings reports every 3 months, called quarterly earnings. and why the market often moves dramatically on those days. Force number 2, investor sentiment and news. The stock market is not just numbers. It's human psychology at massive scale. If the news says the economy is booming, people feel confident. They invest more. Markets rise. If the news says a recession is coming, people get scared. They sell. Markets fall. This is why markets sometimes seem irrational, because humans are irrational. Fear and greed drive markets more than logic. Warren Buffett said it perfectly. Be fearful when others are greedy, and greedy when others are fearful. Force number 3, interest rates and economic data. When the Federal Reserve raises interest rates, borrowing becomes expensive. Companies make less profit. Investors move money out of stocks into safer assets. Markets go down. When rates are low, borrowing is cheap. Companies grow faster. Investors take more risk. Markets go up. This is why everyone pays so much attention to what the Fed says. A single announcement from the Federal Reserve can move the entire market by 2 to 3% in one day. Now, I know what some of you are thinking. This sounds complicated. How do I know what to buy? Don't worry, we're getting there. But first, quick pause. If this is making sense and you're learning something new, hit that like button right now. It seriously helps this channel grow. And if you're not subscribed, do it now. We have a lot more coming. Not all stocks are the same. Understanding the different types will help you make smarter decisions when you start building your portfolio. Type 1, growth stocks. These are companies that are growing fast. Think Tesla, Nvidia, Amazon in its early days. They reinvest all their profits back into the business. They rarely pay dividends. But if the company succeeds, the stock price can multiply dramatically. Higher potential reward, higher risk. Perfect for younger investors with time on their side. Type 2, value stocks. These are established companies that are currently underpriced relative to their true value. Think of it like finding a designer watch at a thrift store for $20. Warren Buffett built his entire fortune on value investing. He looks for great companies trading at a discount, more stable than growth stocks, lower risk, steady, reliable returns over time. Type 3, dividend stocks. These are companies that share their profits with shareholders through regular payments called dividends. Think Coca-Cola, Johnson & Johnson, Procter & Gamble. Every quarter, they deposit money directly into your account, just for owning the stock. This is what people mean when they say earning money while you sleep. Dividend stocks are the foundation of many long-term wealth-building strategies. Type 4, blue chip stocks. These are the giants, the household names. Apple, Microsoft, Google, Amazon, Berkshire Hathaway. Massive companies with proven track records. They don't grow as explosively as smaller companies, but they're stable, reliable, and trusted. The backbone of most serious portfolios. Type 5, penny stocks. These are stocks trading for less than $5 per share, usually small, unknown companies. They're highly speculative. Some people get rich, most people lose money. As a beginner, stay away from penny stocks. They are gambling, not investing. The key takeaway here is this. Your portfolio should have a mix of these types based on your age, goals, and risk tolerance. We'll do a complete portfolio building guide in a future video. Subscribe so you don't miss it. You've heard these names on the news. The S&P 500 is up 1.2% today. The Dow Jones dropped 300 points. NASDAQ hits a new record high. But what are they actually? A stock market index is basically a measuring tool. It tracks a specific group of stocks to give you a snapshot of how the overall market is doing. The S&P 500. This is the most important index in the world. It tracks the 500 largest publicly traded companies in the US. Apple, Microsoft, Amazon, Google, JP Morgan, the biggest, most powerful companies on Earth. When people say the market is up or the market is down, they're almost always talking about the S&P 500. Historically, the S&P 500 has returned an average of about 10% per year over the long term. That might not sound exciting, but remember, compound interest. 10% per year consistently for 30 years turns $10,000 into over $174,000. The Dow Jones Industrial Average. This is the oldest stock market index, created in 1896. It tracks just 30 major U.S. companies. Companies like Boeing, Goldman Sachs, Nike, and Disney. It's less comprehensive than the S&P 500, but still widely watched as a market indicator. The NASDAQ Composite. This index tracks over 3,000 companies listed on the NASDAQ exchange. It's heavily weighted toward technology companies. So when tech is booming, NASDAQ leads. When tech sells off, NASDAQ drops harder. Why do indexes matter for you? Because instead of trying to pick individual stocks, you can invest in the entire index. A product called an index fund, or ETF, lets you buy a tiny piece of all 500 companies in the S&P 500 with one single purchase. Instant diversification, low fees, proven returns. This is the strategy Warren Buffett himself has recommended for most everyday investors. And it's the strategy we'll cover in depth in our upcoming ETF video. You've probably heard these terms. We're in a bull market, the bear market is here. What do they actually mean? A bull market is when stock prices are rising, generally defined as a rise of 20% or more from recent lows. The economy is growing, people are employed, confident, spending, companies are profitable, investors are optimistic. Everyone feels like a genius in a bull market. The longest bull market in U.S. history ran from 2009 to 2020, over 11 years. The S&P 500 rose over 400% during that period. A bear market is the opposite. Prices falling 20% or more from recent highs. The economy is slowing. Fear and uncertainty dominate. Investors sell in panic. The 2008 financial crisis. The COVID crash of 2020. These were bear markets. But here's the most important thing to understand. Bear markets are temporary. In the history of the U.S. stock market, every single bear market has been followed by a bull market that went higher than before. Every single one. The investors who got rich weren't the ones who predicted the crash. They were the ones who stayed in. Or better, bought more when everyone else was panicking. This is the mindset that separates wealth builders from everyone else. The market will crash again. That is certain. What's also certain is that it will recover. Your job is to stay calm when others panic. All right, this is the part you've been waiting for. How do you actually get started? It's simpler than you think. Here are the exact steps. Step 1. Open a brokerage account. A brokerage is a platform that lets you buy and sell stocks. The most popular options for beginners. Fidelity, best overall. No fees, excellent tools. Charles Schwab, great for long-term investors. Robinhood, simple and beginner-friendly. TD Ameritrade, powerful research tools. Opening an account takes about 10 minutes online. You'll need your ID and bank account details. That's it. Step 2. Fund your account. Transfer money from your bank into your brokerage. You can start with as little as $1 in some platforms. But realistically, start with whatever you can consistently invest. Even $50 or $100 a month is a powerful start. Remember, it's not about the amount. It's about the habit and the time in the market. Step 3. Decide what to buy. As a beginner, start simple. Option A. S&P 500 Index Fund or ETF. Ticker symbol VOO from Vanguard. Or SPY. You're buying a piece of the 500 largest U.S. companies. Diversified, simple, proven. Option B. Total Market ETF. Ticker symbol VTI. Even broader. Covers the entire U.S. stock market. These two options alone can build you serious wealth over time. No stock picking, no research, no stress. Step 4. Invest consistently. This is called dollar cost averaging. Instead of trying to time the market, you invest a fixed amount every single month. Market is up, you buy. Market is down, you buy more shares for less money. Over time, your average cost is optimized automatically, and you remove all the emotion from investing. Set it up on auto-invest. Forget about it. Check it once a quarter. This simple strategy, done consistently, has made ordinary people millionaires. Step 5. Be patient. The stock market is not a slot machine. It's not a get-rich-quick scheme. It's a wealth-building machine that requires time. 5 years, 10 years, 20 years. The longer you stay, the more powerful it becomes. The people who fail in the stock market are almost always the ones who gave up too early. Before we wrap up, I need to warn you about the mistakes that cost beginners thousands of dollars. Mistake number 1, trying to time the market. I'll wait until it crashes to buy. I'll sell before it drops. Nobody, not even the best investors in the world, can consistently time the market. Time in the market always beats timing the market. Mistake number 2, panic selling. The market drops 20%. You panic. You sell everything. Then the market recovers. You've locked in your losses. This is the single most expensive mistake investors make. Mistake number 3, putting all your money in one stock. If that company fails, you lose everything. Diversification is not optional. It's essential. Mistake number 4, following social media tips. Someone on TikTok tells you to buy a certain stock, and suddenly 1 million people pile in. That's called a pump and dump. And the people who get hurt are always the ones who followed the hype. Do your own research. Always. Mistake number 5, not starting. This is the biggest mistake of all. Every day you wait is a day of compound interest you'll never get back. The perfect moment doesn't exist. Start with what you have. Start now. Let's bring it all together. Today you learned the stock market is a marketplace for buying ownership in companies. Stock prices move based on supply, demand, and sentiment. There are different types of stocks, each with different risk and reward. Indexes like the S&P 500 track overall market performance. Bull and bear markets are normal, and both are opportunities. Starting is simple. Open an account, buy index funds, stay consistent. The biggest mistakes are emotional ones. Avoid them. This is the foundation. Everything else we cover on this channel builds on what you learned today. Next week, we're going deep on ETFs. What they are, how they work, and why they might be the single best investment vehicle for most people. You do not want to miss that one. If this video helped you understand the stock market, please hit the like button right now. It takes 2 seconds, and it means the world to this channel. And if you're not subscribed yet, click that subscribe button and turn on the bell. Every week, we release content that can genuinely change your financial future. Share this video with someone who needs to see it. A friend, a sibling, anyone who's ever said, "I don't understand the stock market." This video is for them. Thank you for watching. I'll see you in the next one. Stay smart, stay consistent, and keep building.